Continuing in Chapter 9, Receivables, the nut of this chapter is the allowance method and the allowance for doubtful accounts. As shown here, the allowance for doubtful accounts is also called allowance for bad debts, interchangeable names, is a contra account that sits underneath the accounts receivable. It's a current asset. It's a contra current asset. A contra current asset. Meaning its normal balance is credit and not debit. It reduces the receivable account. The gross receivable account is reduced by that allowance account. The net amount realizable value is shown on the balance sheet. The key is in populating and unpopulating that account. So, as a contra account underneath accounts receivable is normal debit balance. Normal balance in the allowance for doubtful accounts is a credit balance. It reduces the amount shown in accounts receivable. The net amount is what's displayed on the balance sheet. So key to understanding that how this account is populated with a credit. This account is loaded or populated with estimated credits. The chapter calls it a pool of unknown future collectibles. An unknown pool of future collectibles that we estimate. Do not wait until a customer, if a customer is not going to pay his bill. We estimate that in advance in order to match it with current revenues of the period. So we have a pool of unknown future uncollectibles with a credit entry to this account. As allowance is loaded up with credits, as it's loaded with credits, we are debiting bad debt expense in the income statement to get the matching with credit sales. So we're loading the account with credits. By the way, this loading of this account, the chapter will call it by various names, making an adjustment entry, making a provision for bad debt expense, or provide for estimated bad debts, various descriptions of how this account is populated with credits. How do we unload this account? We use up the balances with actual customer write-offs. Specific receivables that are reduced are taken against this account. So again, loading it, stage 1 with estimates, debit bad debt expense, credit the allowance account, load it up, which is offsetting this other current receivable, accounts receivable, current asset rather. In the second phase, we remove specific receivables from our main account receivable account when we abandon them 6 months, a year later. We write them off, and the offset entry is a debit to allowance for doubtful accounts. Here, the allowance account is unloaded. Unloaded. Specific customer write-offs. The allowance account will be populated periodically, month end, quarter end, but it will be unloaded whenever a receivable is written off. And again, a company may wait 6 months or 12 months before they write off a specific customer, but a specific customer can be written off anytime during the month. Loaded periodically, unloaded when necessary. And that unloading is strictly a balance sheet entry. Reduce the allowance account, reduce the account receivable account. Balance sheet entry. That unloading never affects bad debt expense when a specific account is removed from receivables. The offset is in another balance sheet account. So to recap, The allowance account is a balance sheet account. It could be called allowance for doubtful accounts. It could be called allowance for bad debts, interchangeable. The chapter uses the bad debt verbiage, but do not confuse it with the income statement account bad debt expense. Two separate accounts. Bad debt expense is on the income statement. Allowance for doubtful accounts is on the balance sheet. The allowance account is a contra asset account, meaning it offsets the account receivable account. Contra, meaning it should have a net credit balance at any point in time. And it lowers the value of gross receivables without removing any specific customer account. That's how the allowance method works. Reduces the total receivable position of the company without naming a specific customer. Here's a question. Could this allowance account ever develop a debit balance? Generally not. It could momentarily if there's some large customer write-offs that overcome the credit balance previously. And you may have some examples in your chapter that problems that give you that example. But generally speaking, we're loading this periodically to estimate future actual write-offs against that account. Before you leave this chapter, ensure that you understand when this account is loaded. That's when you go to bad debt expense. It's loaded with an estimate. E equals E. As we estimate our bad debt expense, that's when the account is loaded with credits. The unloading comes when we use those credits when a specific account is reduced from receivables. Then we also lower the allowance account. At that point, it's unloaded or reduced. Whenever necessary, whenever a specific account is written off, the contra entry is to the allowance account that was previously loaded on an estimated basis. So in the second phase here, I'll say A equals A. On an actual basis, as actual specific customers are written off, we only use asset accounts. Main receivable accounts, current asset account, allowance for doubtful accounts is a contra asset account. A equals A in the actual phase as opposed to the estimated phase. Estimate stage reduces the asset side completely. The actual stage does not reduce the net realizable value and does not touch the expense account. The net realizable asset is not reduced in the actual stage of a write-off. It's reduced in the estimate stage. That estimate stage reduces net realizable value, not the actual stage. Actual using asset accounts only. And even after that write-off, there will, generally speaking, there should be a credit balance remaining in the allowance account. Understanding the loading and unloading dynamic will assist in seeing how this allowance account works in Chapter 9.